Good afternoon, everyone. I'm Jonathan Satchell, Chief Executive of Learning Technologies Group, and thank you to Paul and Doug for inviting me here to talk to you briefly about our company today. I'm mindful of time, so I will, if you don't mind, canter through these slides fairly swiftly, and I believe that we'll be allowing a little bit of time for questions afterwards. I'm joined by our Finance Director, Neil Elton, who's going to take us through the numbers in a short while. I want you to hold this thought, if you would. I've been in the learning industry for about 2.5 decades by acquiring a video training business back in the mid-late 90s. And one of the things that I've always found really frustrating is that learning, when I talk about learning, by the way, I mean adult workplace learning, is always something that doesn't really get on the agenda of senior management teams. It never seems to quite get to the point where they're worried about it. They devolve that responsibility to their HR manager or their learning manager. And the absolute heart of our strategy is to get senior management teams to engage with the importance of improving the performance of their staff. We are living in an ever-increasing service-based economy, and you imagine the differential you can create to the bottom line and other aspects of your business if you can just crank up the performance of your teams just that little bit by giving more learning input and also having an ability to monitor how that learning input is having an effect. Learning Technologies Group was created in November 2013. We did a reverse takeover. Some of you may be aware of a name-listed company, very successful name-listed company called RWS Group. It's a patent translation business run by Chairman Andrew Brody. He supported me in the acquisition of a privately owned e-learning company back in 2008 called Epic down in Brighton. We acquired that and went through a bit of a turnaround phase for a couple of years and then decided what we were going to do. And we looked at the opportunities that we had and we decided that we thought that the industry was right for consolidation. So we chose to go down that route. We then assessed whether it was better to finance that with private equity or to go onto the public markets. And we felt it was very much better to do the latter because the sorts of businesses we wanted to acquire, we really wanted the owner managers to come on the journey with us, and therefore having a perceived sense of liquidity and an ownership of the stock alongside us was important to us. I'm going to go into the individual companies in a little bit of detail in a moment, but suffice to say that Leo is effectively the core stub business. It's actually called something different now. The original business called Epic, and we acquired another business first called Line to form Leo. All of the other businesses, bar Gomo, which we created ourselves, are acquisitions. We've made 4 acquisitions in the last 2.5 years, and I'm pleased to say that they have all been substantially earnings accretive and have integrated very well. I doubt I need to emphasize this to you because we all live in a modern digital age, but it's probably just important to say that the things that you do and that you know that your families do and your colleagues do in terms of the way you live your lives with mobile devices and how the internet is all pervasive in your life, they travel into a learning situation about 6 or 12 months later. So we were delivering learning via mobile devices about a year after the iPad came to the fore. And effectively, learners use their device in a very similar way to the way that you use your device to acquire information. And actually, there's a real big read across. When you're searching for something on Google or trying to find the answer to a question, you are effectively doing a form of informal learning. So the market is large. The mature markets in North America and Europe are growing at a moderate rate, 5 to 7%. But that's the overall global corporate training, those markets' corporate training spend. But if you actually look inside, what's happening is that the digital proportion of that training spend is really becoming quite dramatically higher. And that's where we're taking most advantage. Although we're not just focused on delivering pure digital e-learning solutions, we actually do very much regard the importance of a blend. There are times when if you want to learn something complex and you want to interact with someone to ask questions and perhaps get them to coach you and help you to change your behavior, it is much better to have a facilitated coach-led session than it is to always look at the screen. And the art of great learning design is to consider those components best and how they mesh together and work in a blended form. And I would argue that our business and the experts within it are very good at doing that. We regard our business in 2 different ways and meld it together. Many organizations talk about themselves being a buy and build strategy. We are a buy and build business. That's why we came to the market to consolidate the industry. But we came with a very sound fundamental ethos underpinning that, and that is to observe the basic tenets of running the business properly. So we chase hard organic growth. we focus very much on profitability and cash generation from that profitability. So the fundamentals are sound. We augment that with what I hope thus far has been a very powerful and positive acquisition strategy. We have a very experienced board that help us not to do deals probably more often than do deals, which I'm sure you'll be appreciative of. We have thus far, as I say, made 4 acquisitions. When we're assessing acquisitions, we look at them through these 3 lenses. We first of all say, can it add genuine and beneficial capability to the group? If it can, what is that? And you'll see that on the left-hand side is our capability thus far. I'm sorry, the text is quite small. And on the right are areas that we would consider either acquiring or partnering with or growing ourselves. That will broaden the group to a point whereby I genuinely think we will be a full-service agency, for want of a better term, and that's our aim to get to. The other aspect is that in many of our businesses, we are deliberately a generalist. So Leo, for instance, which is our main custom content business, is just as comfortable building a piece of content to train Augusta Westland helicopter pilots in search and rescue techniques as it is training a teacher via the child bereavement counsel about how to deal with a child that's going through a difficult situation with a bereavement of a sibling or a parent. Those are, as you can see, incredibly disparate and diverse topics, and that's just a mere one set of examples. Our businesses are structured, therefore, deliberately not to have internal subject matter experts, but to be able to assimilate the understanding of the subject from the customer and then deliver it back to them in an appropriate learning form. However, we do think there are certain markets where having sector specialisation is really useful. One of those is financial services compliance, and we made an acquisition last summer of a company called Euclair, based in the City of London, just down the road, and they are focused on financial services governance, risk and compliance, mostly for investment and retail banks, and that was in fact the transaction that Paul and Doug chose to support us on. We are quite keen on a couple of other what I call must-have sectors, for instance, pharma, heavily regulated, aviation, and also retail, where they regard you as having other retail clients as being a fantastic sort of read across and specialism. The final lens that we consider acquisitions through is geography. We are a relatively small senior management team, 4 of us. So we are not trying to conquer the world. We know that we would fail if we did so, but we are very strong in Europe, mostly concentrated geographically in the UK, but we've got good strength in Europe. And where we have our eyes most focused is North America. It is clearly the biggest market, and it's the easiest one to penetrate. We already have grown our own business out of New York, but it's relatively small, and our goal is to at least get to the size in North America as we are in Europe. We may then cast our eyes further eastwards, but we are not going on a global acquisition spree. Neil, do you want to talk to the numbers?
Just a few figures here to highlight and underpin what Jonathan was saying about our strategy. This is looking back over the last 3 calendar years. These are all audited results. So in terms of revenue, it's a mixture of organic growth and growth through acquisition. And you'll see that between 2013 and 2014, we almost doubled revenue year on year. And you can see the breakdown between what we acquired and the organic growth there. And into 2015, again, 33% year on year revenue growth, but again, with strong organic growth within the business. Probably even more stark is the effect that has had on EBITDA. We're very mindful of running the business tightly in terms of gross margin and utilisation. That's something we very much focus on. So you'll see that in 2014, when we acquired Line, they were much less profitable than Epic had been back in 2013. Hence, you see the drop to 14% EBITDA in 2014. But we then recovered that into 2015 by introducing the working practices we had in Epic, and we also identified some other synergies. So you'll see some very impressive growth, up to 21% EBITDA margin. And in terms of Numis Forecast, who are our house broker, so take it as you will, they're predicting 23% EBITDA margin for this year. So, and we're comfortable with that. That has all manifested itself in positive earnings per share on any measure, and in particularly adjusted diluted EPS, which is our favoured way of looking at things, which doubled year on year. And there's also very strong cash generation. So you'll see there, bottom right-hand corner, we had 7.3 million cash in the bank at the end of the year, and we generated 4 million cash, operating cash, on EBITDA of 4.3 million. So very cash generative, and maybe unusually for a company of our relative young years and acquisition growth, we do have a progressive but limited dividend policy. So again, you'll see that increased 50% year on year, and there's a dividend of 0.1 pence per share being paid on the 4th of July. And I'll hand back to Jonathan.
Thank you. These are the acquisitions that we've made. I'm not going to read any of the numbers on this slide. If anyone would like to ask us questions, we're very welcome to. I just want to highlight a couple of principles. Firstly, we are very assiduous in the way that we assess management teams. We don't want someone who's looking to sell out. We are much keener in organisations where the management believes in the LTG journey and wants to join us on that, and therefore they will take some of the proceeds of the acquisition in stock. And furthermore, other than our first acquisition, which for different reasons we didn't have an earn-out on, every single acquisition since has had a reasonably high proportion, between 20 and 40% of an earn-out, and that's based entirely on revenue growth. And the reason we do this is we feel comfortable enough that we can control the margins when we own the business, and we want the owners of the business to focus very much on driving that top line growth. We think that's where their interest will be most aligned with ours. So a little bit more detail about the businesses, but I'm mindful of time and count through this very quickly. I've mentioned Leo. Leo delivers custom e-learning content solutions and platforms. Most notably, if any of you have tracked Learning Technologies Group at all, in December last year, we announced a very significant contract. We won, in partnership with KPMG, the contract to run the government's entire learning service, civil service learning. Now, we were involved with this business before in that I won the contract back in 2011 just to deliver the digital aspect, but the managed service provision of all the other courses, the government, you might imagine, puts many hundreds of thousands of people through classroom courses every year. That was delivered by Capita. And what has happened now is that the government re-tendered this in the summer of last year and asked for a blended approach. We knew we couldn't deliver the face-to-face courses element, but we partnered with KPMG and won that overall contract. And most importantly, the way we've structured our partnership with KPMG, we are exposed to all of the revenue stream, both for digital and face-to-face courses. And we are investing heavily this year in building that entire set of curriculum for the digital courses. But over the 3-year current life of the contract, it may well extend at the government's gift. We expect the revenues that will accrue from that to be very, very substantial indeed. If I just give you one indicator, the spend with Capita over the prior couple of years was around about £40 million a year. And we will share in a similar revenue stream alongside our partner KPMG. I mentioned that we've grown the business ourselves. One of the most profound changes in our marketplace occurred with a conflation of a couple of different things that happened in 2010-11. The tablet segment arrived with the arrival originally of the iPad, and then obviously it was followed by many other mobile devices. And that had a profound effect in that we could just all of a sudden, with a very easy device, access content wherever we were, whatever we were doing. And that really is fantastically useful for learning. At the same time, we were coming to the end, as we all know, of a deep, dark recession. And one of the things that have been cut dramatically in terms of spend was face-to-face training. So companies were not flying their executives to exotic hotels to sit on a 3-day training course anymore. That spend had just disappeared. And what's happened is because of the convenience of digital, that spend hasn't really re-emerged in the same way. Of course it's there, but it's not the same proportion. And it's had really quite a profound effect on the way people learn. We had some technology that we created which was delivering mobile learning. Mobile's a problem for us, problem for everybody in the web industry, in that what you've got is this myriad of different shaped devices. You've got a phone in your pocket, yours is different to mine. We have to make that screen shape itself properly for that, for an Android tablet, for a laptop. It's hard work, and especially if you've got volatile content that's constantly changing, you want to change it in one place and know that technology will do all the rest of it for you. That's what Gomo does, and it's becoming the leading, what we call multi-device learning authoring tool. Now you might think, why are we selling customers an authoring tool? Well, we recognise that effectively, although it partially cannibalises our revenue, it also gives us a foot in the door with customers that wouldn't use us otherwise. So, for instance, we used to make all of Carphone Warehouse's product updates. Every time a new mobile phone came out, we would deliver the new data about that mobile phone. They then recognised that actually it wasn't that hard what we were doing. They didn't need to pay an external agency to do it, so they took it in-house. Now they now use our own tool to do so, and they often borrow our staff alongside them in the cloud to deliver that. So it gives you some idea of the importance of covering that segment of the market. It also is an internal, growing SaaS business with a very nice recurring revenue stream. We bought a games business 2 years ago. That is fully intended to deliver corporate training games, but we are very delighted that it's continued to plough its own furrow in terms of the customers that it had partially in education, but also in high-quality game, what we call games with purpose. Most notably recently has been delivering games to McDonald's restaurants customers, whereby, as part of their corporate and social responsibility policy, they are delivering learning games to their Happy Meal customers. So if any of you have a cause to be in a McDonald's restaurant and have a Happy Meal, you will be able to find that you're invited to download and play a game, and that's been built by the Preloaded studio. And that contract, because of the very nature of the way it revolves with new movie licenses, because McDonald's links with characters from movies, continues well into the future. I mentioned our governance, risk and compliance business. And as I say, that specialist sector specialisation is really important to us. And you may well expect that we will add further capabilities in other sectors to the group as we move forward. Finally, I want to talk about this because I want to bring you back to the thought I gave you at the beginning about moving learning to the heart of business strategy. I think you can only get the senior executives' notice in a business if you can give them something that is measurable and provable. And what Rustici allows us to do alongside our investment in a company called Watershed is give objective empirical evidence of whether learning is being effective in the organisation or not. We can now finally measure the effectiveness of learning. And I'll give you a couple of real-life examples. We are now monitoring the way paramedics in the Midwest of America are being trained on a certain new technique for dealing with cardiac arrest. That data is kept in a separate database, or part of the standards that this organisation has developed. And alongside that, we're correlating it with the 911 data and the hospital's own data of the patient outcome. So 911 call comes in, paramedics dispatched, treats patient with a particular technique. Patient, sadly, obviously, outcome is lives or dies. You correlate that data with whether that paramedic understands and knows a new technique, how competent they are in it, and we are starting to see statistically meaningful evidence of the new technique working in certain circumstances. That gives you an idea of how profound and important this can be. If one gets a little bit more boring, then we're talking to HMRC about the way certain calls are answered on a VAT call centre. And we are monitoring it as a sort of control group, the way we've trained certain HMRC call centre operators in a piece of VAT legislation change, and the call routing system puts it through to those people, and we can now see from the routing system, because that obviously monitors the call outcome, whether a satisfactory and successful outcome comes from the call. And we shouldn't be scared of the fact we may find that our training has not been effective enough in making those people more effective at delivering the successful outcome of the call. But the interesting thing is we're finally able to have strategic conversations with organisations about the effectiveness of their learning. And the final aspect of this that might become rather interesting to you is that we work with an awful lot of leading brands. So, for instance, Jaguar Land Rover has been a long-standing customer of ours. We now deliver every aspect of their new vehicle training around the world in multiple languages on iPad on a timely basis very shortly before the car is launched. What they're now doing is looking at the correlation between the people that we monitor and track who uses the iPads, the people who go through the new product training and pass the assessment and demonstrate that they have a knowledge of the new vehicle, and how many sales they make of that vehicle. And they're beginning in a very devolved situation. This is a franchise dealer network all over the world owned by many different organisations. Jaguar Land Rover at the centre is now able to start indirectly managing the performance of the salespeople in the showrooms in Shanghai. It's quite an extraordinary thing, and that's underpinned by this technology.